Westpac has been the first to move on the RBA decision yesterday. We saw a 0.5% increase in the official cash rate. Westpac's variable home loan interest rate now sits at 5.33%. That's from June 21. Joining me live now is Westpac senior economist Matthew Hassan. Matthew, thanks so much for your time. Sorry to keep you waiting. First of all, what is the benefit in a big bank like Westpac going first, and why do you think the other banks haven't moved yet?
I can't speak for others in the decisions. There's a bit of cat and mouse that happens with the response on rates. The big picture here is that we're moving into an interest rate tightening cycle, and this will be one of many interest rate increases that we see between now and the end of the year. And we think it'll extend into early next year as well. There's further to go, and week to week there may be variations across the lenders, but that's the decision-making process.
How much further to go do you think?
We think there's a fair bit. Even with this 50 basis point move, the cash rate is just 0.85. It's clearly well below levels that would be considered neutral. Really, we've only just unwound the emergency rate cuts that we saw during the COVID period, and we're sitting on a real problem as far as inflation goes. Headline inflation is above 5%. It's above 5% globally. And we're starting to see new fronts on the inflation challenge emerge domestically around electricity costs, for example. There's a real risk around the cost of new housing and new building. And at the same time, we have some pretty important wage decisions coming through over the next few months. That's suggesting this is going to be a longer lasting fight for the RBA. And it's really pretty important that they get very quickly back to a more appropriate setting for the cash rate. Other central banks globally are in the fight as well, and the RBA is starting to play catch up in some ways with its bigger move. So look, we think it'll move a lot further. We think the peak in the cash rate will be north of 2%. We think 2.35 is where that will probably top out. That's a pretty rapid reset for interest rates for borrowers. It's going to be a tough time for many to absorb that increase, but it's in everyone's interest that we return inflation to the 2 to 3% band as quickly as possible.
Yeah, it's a rapid increase, Matthew, but still, even less than 2.5%, it's still pretty historically low. So how much pressure will this actually put on families? And will it just be a smaller cohort, do you think?
Look, that's one of the really big questions at the moment that economists everywhere in Australia are trying to assess. We know that the debt servicing ratio for Australia's mortgage balance is going to be more sensitive to interest rate increases than in previous cycles. That said, the challenge here is around inflation. We haven't had an inflation like this globally or in Australia for well over 20 or 30 years. So it's a different situation than we're used to. It's not just about leaning to restrain demand. It needs to be weak enough to resolve some of these inflation pressures and ease pressures in the labour market. So, it's not just about how heavily they're weighing on the household sector. There's an overriding issue now around inflation. We think 2.35, that's a more aggressive or a heavier lean on households than we saw during the previous tightening cycle in 2009-10, but not quite as heavy as we saw through the pre-GFC period when mortgage rates averaged 9.5% for 12 months. That was through 2007-2008. So we're calibrating that very carefully as far as how heavily does the RBA need to lean domestically to achieve its inflation objectives over the medium term. But as I said, this inflation story is very different than what we've used to over the last 20 to 30 years, and the persistence of inflation is very uncertain over this.
Well, it's interesting to see a note between the intervening 4 weeks between RBA meetings. We see the RBA even more worried about inflation than they were last month, and they were saying, around 6%. Now it's moving faster than even the RBA anticipated. With that said, monetary policy can only do so much to curb inflation. Does the RBA, in the minutes or in anything we're hearing from the governor, recognise that too?
Look, I think the mandate for the RBA is very clear. It's an inflation stability target. That is its prime target. And so monetary policy, yes, it will struggle to address some of these supply side issues, but there's no real choice here. The inflation needs to be reined in or kept in check. There is a little bit of flexibility with the target in that it's on average over the medium term. So there is some flex there for the RBA to allow the inflation rate to be above its 2 to 3% target for a period, but it needs to be convinced that over the medium term it will be returning to target. So, so far, that's, I think the message we're getting now from the RBA is much clearer around its inflation targeting ambition and its efforts to return inflation to target. I think it's very risky behaviour in this situation to assume that we will return to target naturally over the course of the next couple of years. It's going to take some policy tightening to achieve that. We don't know exactly how much, but we know these supply side issues are very deep-seated. The inflationary pressures are very large here and now, and I would say that the inflation threat front is widening, not narrowing. We're starting to see a disturbing rise in electricity costs in the wholesale markets in Australia that's associated with gas prices. It may come back a bit, but it's really pointing to another front on the inflation side of things. Domestically, we have this open question around how wages are going to unfold over the next 12 months. At the same time, I think there's some really big questions around new building costs. We know that the building sector is sitting on a backlog of about 100,000 dwellings that are under construction at the moment, that are on fixed price terms, and they're underwater because of the large increase in costs, and that's going to flow through to the front end pricing. So I think our concern is that inflation is already very strong. Some components will invariably slow. We're not going to get another doubling in oil prices. But at the same time, the domestic side of the picture is starting to look a little bit more problematic, and it's looking like it'll last longer. So from the RBA's point of view, the question is, how do you approach this? You can put all your eggs in the basket that these supply side issues will resolve and we'll get a moderation in inflation and some disinflationary forces coming through in a year's time. That looks like a very high risk approach. The better approach, we think, is to front load the tightening to a degree and not have to overcorrect down the line. If they move quickly and aggressively earlier on, then if some of those other upside risks of inflation materialise, they're better placed to address them, and they're less likely to face the multi-year inflation fight that we've seen in the past. The only really similar period that we've had to this was in the 70s and 80s, and that was a disaster for the global economy. It was a period of stagflation in which it took 10, 15 years, in the case of Australia, closer to 20 years to bring inflation back under control, and was very damaging for our economy through that process. We definitely don't want to get into that sort of price-wage spiral, that entrenched inflation situation that makes it extremely difficult to, requires a multi-year high interest rates to really bring things back under control. Now's our opportunity to some extent head that off with more appropriate policy straight away.
Okay, Matthew, thanks so much. We'll see you soon.
Thank you.